South Africa's middle class and higher class is under severe financial strain. According to the Experian Consumer Default Index, mid to high income households are increasingly defaulting on their home loans or on their loans in general. Home loan defaults have increased significantly over the past 18 months. It further indicates that the most affluent segment of the market continues to struggle to repay their debts and are increasingly relying on credit cards to make ends meet. Experian Africa's head of commercial strategy, Jaco van Jaarsveldt, joins us now to talk and elaborate further on this matter. Great to have you, Jaco. Thank you very, very much for your time.
It's a pleasure to be on. Thanks for having me.
So I suppose to put it all into perspective, perhaps you can give us the value or the total value of outstanding credit in the South African market and how many South Africans are actually under strain right now that are credit active consumers and they have that access to the type of debt we're talking about.
Yeah, so the total outstanding credit in the market is about 2.3 trillion rand. And that is exposure to roughly 30 million credit active consumers. Now, that 2.3 trillion rand is split across different products, with the secured lending products, which is home loans and vehicle finance, contributing to about 1.8 trillion rand of the total 2.3 trillion rand. So if you think about it from a secured lending perspective, by far the majority, in excess of 70% of outstanding debt, secured lending products, with home loans being around 1.4, 1.5 trillion rand. That 1.5 trillion for home loans and the additional 400 million for vehicle finance, the secured lending component, is in the hands of 12.5% of that 30 million consumers, which is the most affluent consumers, as you said, Leanne. And they are exposed to both the cost of living from an inflation perspective and obviously the high fuel costs, electricity costs, etc. But equally, they are the most exposed to the high interest rate environment, where the rest of the market, the remaining 85%, that's generally exposed to unsecured credit, more in the personal loans, credit card, and less in the credit card, more personal loans, and in the retail space, they're only exposed to around about half a billion rands worth of credit.
It's unbelievable. I mean, that's a scary picture. When were we last in such a difficult situation when we are talking to this grouping of people?
It's actually a very interesting analysis that we've done. We've looked at the impact of interest rates and cost of living across a 25-year period. And we've realized that there's a big difference between what happened in the different periods. So if you look at the late 90s, early 2000s, during the financial crisis, personally bought my first car then, and interest rate I paid was around 23% on the car, if I recall. And that was during the toughest time at that crisis. And what we're seeing now happened then. In essence, what happened was we went through that process. We got to a point where a lot of people were exposed to the high levels of interest rates and high level of inflation for the first time, and we saw similar defaults. During the 2008 financial crisis, it was very, very different. As the people that was exposed during the 90s learned their lesson, and there was a lesser extent of new credit people, new consumers that bought homes, etc. during that stage. So the default rate on the most affluent consumers wasn't as great during the financial crisis in 2008, 2009. Beyond that, and at 2008, 2009, we got a lot of equity pushed into the markets from the different central banks. And we had a lot of very cheap free money. And as a result of that, a lot of new entrants entered the market across the world and in South Africa. And what's happening now is that population that entered the market then is exposed to these levels of high interest rates and high inflation for the first time ever. And it's almost like we're seeing the exact same thing that happened in the late 90s, early 2000s occurring again, simply because it's the first time that this new generation that got very cheap money, access to homes for the first time, feeling the pinch right now.
Amazing. I mean, it's quite a worry. But I suppose let's understand how this the index works, because we talk about the deterioration, but how accurate is it when we're talking to consumers' distress and how it's actually measured?
So what the index does is it looks at rolling defaults of consumers that default for the first time beyond 3 months or 3 months and more in arrears across any of their credit products. So in essence, it's a very early indicator of consumer distress, and it's defaulting for the first time ever. So it's first payment default beyond 3 months plus, 3 months plus in arrears for the first time ever across any of their products. So in essence, what we're looking at is new people that's defaulting, people that's not defaulted before now going into a default state. And as that is a very early indicator of immediate distress in the market, it is pretty accurate in indicating, well, we can clearly see there's a certain segment. And when we look at our Experian financial affluent segmentation, which basically splits the South African consumer market or credit market in 6 groups, from the most affluent to the youth. And across those groups, we also split it by product, which is the home loans, vehicle loans, etc. When you look at defaults at that product level and at that consumer segment level for the first time, it's a very interesting early indicator in terms of distress. And we actually picked this up 18 months ago. We started seeing a deterioration in the default rates in specifically the top end of the market, when interest rates just started going up and we saw the inflation rate. So this is not a new phenomenon. We've seen it for the last 18 months. We've seen this distress, and it's been happening quarter on quarter. It just got worse and worse and worse.
Yeah. So I suppose we need to talk implications of this. I mean, when we see the surge in debt review applications in higher affluent consumers, what happens to the financial institutions and the implications thereof?
Yeah, so I think there's a very big, important message out to consumers. I know debt review is a potential avenue to follow, and we've seen a significant increase in the requests for debt review. Now, what debt review does is once you go into debt review and you're actually in a debt review status, you cannot get access to credit until such a time that you've completed the debt review, settled the debt based on the terms agreed during the debt review agreement, and paid off that debt accordingly. So no access to credit once you enter debt review. I cast my mind back to 2007, 2008, when we saw a similar deterioration in the home loans market as a result of the financial pressures that occurred then. Not to the extent that we see now, but at that stage, I was actually in the home loans environment, and the one mistake that was made at that stage was there was a big drive towards repossessing homes and repossessing the house and then selling the house. But what happened at that stage is exactly what's happening now from a property valuation perspective. We know the property market is under severe distress. We know there's a lot fewer people that qualify for credit to get access to the home loans, to get access to the properties. And in essence, what we learned in the mid to late 2000s was don't repossess properties, rather collect as much money as you can from the consumer. So the advice that we'll always give consumers is the banks know that you're in distress. Contact them and speak to them. Have that conversation, own your credit report, own your credit information, and own that conversation with the banks. They are far more likely to keep you in the house and take an agreed payment arrangement from you over a period of time to help you through the difficult times than repossess the property, because in the late 2000s, all that happened was the banks owned way too many properties, couldn't sell them, and eventually had to auction them at minuscule values relative to the actual value of the property. So the banks are very selective when they come to taking anything back. So they'll rather have that conversation with you. But it's fundamentally important that consumers reach out to these financial institutions beforehand and have the honest conversation. They're not in the business of repossessing or taking your assets from you. They're in the business of getting you and themselves through this difficult situation.
Indeed.
Whereas
and
debt review blocks you from credit.
It does, and people tend to run away from it thinking, I'll just turn my back and it'll disappear. It won't. It just gets worse.
Yes.
And the reality with the increased risk of defaults, particularly in home loans and credit cards, does that mean that banks and other lenders may have to reassess their risk management strategies and lending criteria? I mean, already it's very difficult, but do you think that this is, again, going to see it become even harder?
Yes, what they'll do naturally is tighten their lending criteria. But when we look at the supply of credit over the last 3 quarters, it's been stable at about a 30% accept rate. So they're accepting 3 out of 10 applications, which is significantly lower than it was before, even though demand exceeds the pre-COVID levels by far. So demand is huge, but it's a function of people need credit to make ends meet. The banks are stable, and the credit industry is stable at around 32% supply. The key thing, though, is when you look at the stress on home loans and vehicle finance, that's not new credit. That's credit that's been booked 5 years ago. And those are the consumers that's in distress now. So it's on the bank's book. So there's the banks will tighten, but will they tighten beyond where they are now? Unlikely. What they will do, however, is they'll be very diligent in terms of doing the affordability assessments and looking at building in things like where do they see the interest rates going in future? Because ultimately the returns that they earn is also dependent on the interest revenue, which is positive when we look at bank results in the last few weeks. The bank results that released, the interest income is great, but the impairments are significantly higher as a result of consumer distress.
Yeah.
So yes, they'll tighten to a point where I don't believe they'll go far beyond where they are now, but from a consumer perspective, the key thing is contact the bank. Speak to them. Don't run away. Own your credit report. Your credit report is your data. Go make sure it's accurate. Go make sure it's a true reflection of who you are. Make sure that it is, that you understand it to the nth degree. You're in control of that, and that gives you the power to understand what to do going forward.
A quick question and a final one, because we've run into time constraints, but where all of this economic challenges, they come in, and we're talking about people that are in a fairly sort of middle income earning bracket. What about younger consumers that are new to the credit world? And, you know, this is where you take those risks, but what happens to them?
Yeah, there's a very interesting conversation there that I think we're going to need some more time on. But in essence,
I think so.
4 out of 10 consumers start their credit journey with a retail store card. And we've proven that over many years, over 5 years worth of consumers starting their credit journey, 130 million accounts opened, and we just look where they started. So that's where consumers start. However, retailers post-COVID are granting 30% less credit than they did before COVID because they got off the credit drug, if I can call it that. So the retailers aren't granting that level of credit, which is limiting access for the youth to credit. And that's number one, the first pressure. And the second pressure is there's two components to accessing credit. You need to be credit worthy, and you need to be able to afford it. And if you're not employed, you can't afford it. So that's the key driver that's limiting the youth getting access to credit. There's no supply to the youth because the retailers, where majority of us started our credit journey, aren't granting credit anymore to the levels that they used to because they don't have to. And then secondly, there's no employment for the youth, and therefore if you're not employed, you can't afford it, you can't get credit. And that's where the challenge comes from a youth perspective.
Yeah, indeed. Jaco, we've got to leave it there. Thank you. Thanks for talking to us. A very important conversation, and perhaps that one takeout, if you are struggling and this has spoken to you, go speak to your bank. They're the only people that can help you at this point in time. Don't run away from them. They know exactly what kind of problems you are facing. So Jaco van Jaarsveldt is Experian Africa's head of commercial strategy, speaking about more middle class and rich South Africans that are increasingly defaulting on their loans.